We find that this is a model that has attracted not just first-time investors, not just sophisticated investors, not just experienced investors in venture, but it's really allowing us to capture the imagination and the investment interest of folks that have never invested in venture before.
Michelle, welcome to the show.
Thanks, Ryan. And I am so excited to be on your show. Making Billions is truly creating a strong community that's shining a light on real innovation. And frankly, your focus on people who are out there building things that matter. Well, we need to replicate it and do it over and over. And then honestly, we'd love to have you in Washington, D.C. I invite you to come see our town. And as we continue to focus on doubling down on innovation, I think your expertise is much needed here and will be much appreciated. And again, thank you for having me on your show.
Yeah, thanks for being here. And it would be an honor. I've never been to DC. Actually, I have. I passed through briefly, but I regrettably did not get the experience I had hoped just because it was so brief. And it would be an honor to be there. Now, you are making things happen. So let's dive in. You said that traditional venture is broken. So if you had to point to one practice that makes this industry already dead on arrival, what would that be? And how does your continuum structure solve for that failure?
Sure. The practice I would point to is a strict adherence to specific stage investing. And what do we find? We find, or rather, what is the outcome? The outcome is that companies are funded in specific rounds and never do they see the additional funding rounds. So it truly creates a funding gap, right? So at the Synergos Fund and with our Continuum model, our focus is on the mission of each of these companies. We want them to achieve the solutions that they're delivering to the world around energy, creating more baseload. We have a nuclear play that we love, company, I should say. It's not a play. In the recycling of spent nuclear fuel, waste to sludge, waste to energy, sludge to energy. But we want to solve persistent problems. So this is our mission. And our aligned mission to each of the founders is to support them from the beginning to the end.
Brilliant. So finding that is, I guess, the biggest issue that we're talking about is that stratification and holding too hard to that line. It's interesting. I've seen recently, and I'm not sure if you've seen it as well, but we've even seen private equity kind of do a little bit of what you're seeing is they'll slide into some of the later stage VC. Typically, they didn't play. It was a very clear line to say you get VC up to this point, and then after that, you go to PE, and then after that, you IPO, and then it's public funding. And now you're spot on. I'm seeing it too, where traditional venture, some are calling time of death. I don't think it's that dramatic, but I think what we're really seeing, regardless of all these different calls, is there's definitely some tectonic plates that are shifting in the venture capital space. And the Evergreen model that you guys do is a really cool development of that. Anything else you can add to that?
Yeah, so typically Evergreen funds, they build an exit for their limited partners on a periodic basis. Call it every year, they can make a withdrawal. But that also impacts the true liquidity of the underlying companies, right? Because then you're forced, if you don't have enough buffer, you're forced to liquidate, right? To meet those funding gaps. So it leads to a premature or forced exit, perhaps, right? We don't want to do this, right? So what we do is the Continuum Fund invests in 3 categories. So incubating companies, scaling companies, and then commercializing companies. Therefore, the liquidity demands requirements of our LPs can be met, right? So we can show them some returns, give it the three-year time frame. We target 2 to 3x in that segment, and then call it 5x plus for our scaling over a longer time frame, call it 5 to 7 and 7 and above for our incubating companies. Our mission is to ensure that the companies that we invest in, one, are really needed by the world. And we know that despite the history of all of the venture funding in the world, that persistent challenges still remain, right? We need to keep investing in these impactful deep tech companies. But at the same time, to expand our base of investors, we are meeting that liquidity requirement by investing in later stage companies, right? We find that this is a model that has attracted not just first-time investors, not just sophisticated investors, not just experienced investors in venture, but it's really allowing us to capture the imagination and the investment interest of folks that have never invested in venture before. And there are other characteristics of the fund that we built into it that address other pain points of folks investing in alternatives.
Brilliant. And, with all of that, there's tons of incentives and different things that come in for both entrepreneurs, for fund managers, for limited partners, general partners. There's all kinds of people and everyone in between. So my question for you then is, what inefficiencies and, say, maybe incentives that are misaligned are you seeing in the standard VC or venture capital models right now?
I think the obsessive, if I can call it that, the obsessive focus on quick exits and this culture of information opacity, right? At the Synergos Fund, transparency is very, very key for us or critical for us. The more our underlying investors know about the cohort of portfolio companies they're investing in, I think that just allows them to clearly see that, if they are impact investors, they're seeing the development or the progress with their values, right? Or with their investing values. The fund does not invest necessarily with an eye to a quick exit. Again, our focus is, why are we investing in late stage? So that our incubating companies can get funded by the same investor, right? So that they'll be more willing to support that, because their minimum investment will be covered in a much shorter time versus waiting for your 10+1+1 with a seed stage investment, right? And plus we provide diversity. Yes, we're still focused on a few areas: energy, agriculture, health, mining, but this still is diversified. And we often have these conversations with investors, but I only like agri-tech. I'm already heavily involved with my own business. I own farming companies. I just want nuclear, right? So what we tell them is, well, we want to be able to continue to fund the entire cohort, support the entire cohort. But after your first million, sure, you can dial up. You can increase your investments in Curio, or alternatively, if you wanted more agri-tech, right? And agri-tech, we can have a day's conversation on how agri-tech companies have not gotten the support of venture capitalists, right? So there is a lot of flexibility built into the fund, but this is thoughtful flexibility, right? It, again, addresses the LP's values, and you'll hear me say it 10, 20, 30 times today. Mission alignment is very key for us, which is why our network of investors will have us to be their trusted partner throughout this journey. So that's on the LP side. And that reflects with our relationship with the founders, because guess what they want, right? Founders need a partner. They need an aligned partner for their journey, right? Throughout their growth journey. And that's what we want to be, both from the deployment investing side, close partners to our founders, not getting in their way. In fact, getting out of the way or helping them find a better way. We want to support them. And at the Synergos Fund, I'd love for you to get to meet my co-GPs, Rabbi and Yehuda Moskovitz, strong operators, strong founders. What they're able to bring to their table is their network of experts in these technologies, right? Their expertise in navigating where can we source non-dilutive capital, right? Their ability to map out what can we do to make a stronger, more resilient U.S. economy, and therefore a supportive economy to the global economy, to the world, right? So it's. I think there have been evergreen funds, but the continuum approach is a way that provides foundational strength to the founders so that they can solve, they can deliver their product.
I love that. So, and I'd love to talk about that. So, because I've been wondering this, but meaning to ask you, so how does your Continuum Fund differ from Evergreen or, say, just the traditional venture capital structures?
We'll be able to provide in our Continuum model faster distributions, right? Again, it goes back to that managing for that most conservative investor that doesn't want a long hold. But if we keep that clip going where we give them a distribution every 3 years, and in fact, their minimum is likely already met at that time frame, we want to be able to continue to capture, a share of their wallet for these transformative companies, right? And I think we have many impact funds. We have many impact investors. I care less about measuring impact. I just want to get to the work of really delivering on with these transformative companies.
Brilliant. Now, a lot of times, and I know funds, maybe you've run into it, there's always fees that come up and especially fee sensitivity. So how does your fee sensitive structure practically protect LPs when you're funding that innovation that you're talking about?
It's the transparency and knowing what they're getting into. I think my personal experience is I can understand the 220 fee, which is which is pretty standard. But then all of a sudden you get a capital call for administrative, custodial, all of these other hidden fees that I did not know. I may have signed up to it, but not clearly that it would then run up my annual fee to a ridiculous number between 5 to 10%. And this often happens. And it's even harder for international investors, right? Because they go through a private banking wealth management institution. They have to create an SPV for tax or for other legal regulatory issues, right? And each of those feeder funds, let's call it that, that's what they're called rather, they charge another 5 to 8%, right? So that really erodes the returns to the LPs. And I think it's about time that we try to do what we can. And good news is that there are now powerful tools around administration, right? AI is accelerating and helping the way we do things on a day-to-day basis much faster, much easier, right? Our tools allow for us to report to our investors their capital accounts. They have access to it. Whenever we have updated information on underlying portfolio companies, they get it as soon as we can get the information out to them. For me, information is power for everyone. And we're pretty secure with our deal flow, Ryan, because the truth is they come to us or we create these companies. We help build these companies. I go back and highlight Curio, which is the nuclear energy company. My co-GPs founded this company, right? So where if the solution doesn't exist out there, we will build it.
That's the right attitude. I love it. I'm that way. It's like either it exists or it will exist, but either way, we're getting this deal done.
And we don't want to be the only ones that do this, right? We need to remove the fee drag. We need to remove this friction of fees with investors because there are investors that could be mission aligned, but then you tack on fees that they just can't get over. Let's help them get over that by reasonable fees and transparent fees, right? And also the number of times you call. I mean, you know this, right? What don't you like? Getting a capital call every quarter.
Yeah.
Let's just simplify it. And it costs
Yep.
money to wire, right? Well, what is it not these days? $50 per wire. And, for US investors, that it's probably more convenient, right? Because you can just do an ACH transfer. But like for international investors, there's buying the currency and then the wire fee. So let's remove this. Let's remove this fee friction.
Yeah, and UBTI and double taxation, and it's a lot. And so you want to be, as I like to call, you don't want to be someone pitching deals to investors, although you are. It's better to position yourself as a solution architect, and that essentially shifts you away from pitching deals to now saying not only this deal, but this structure and how we've done it, and our capital calls and our fees. This is a solution for you. It's not a deal, and then you're going to be surprised by all these capital calls for custodial fees. What are some of those fee categories that because we have a lot of family offices around the world. So what are some of those fee categories that you would suggest that they should also check and ask that tend to be a little bit hidden in this industry?
Administrator fees, custodial fees, other soft costs that just eat away at their returns. These subscription documents, we also need to simplify them, right? Because there's a lot of hidden language there that, it's not even in fine print. It's there, but, for newer investors, they don't necessarily understand this, right? They don't have the eagle eye that Ryan Miller has, for example. So let's just simplify it, right? The time engaging with investors should be about the investment, should be about the companies. It shouldn't be about reminding you of your capital call. Please meet it, Sorry, it's funny. I just aged myself with my handheld telephone.
You got it. So, so that's on the fee side. And there's also the investment thesis side. And you and I have spoken about yours when we first met. I'd love to learn more, a little bit about your thesis but my question for you is why prioritize reshoring energy security and ag tech?
What have we seen discussed over the air in recent months is really around supply chain and our reliance on perhaps not the best actors in our world. Nuclear is quite in the forefront of that because we do source raw materials from other countries. we need to build that capability in the US. We already have nuclear fleets where we have the largest nuclear fleet in the world. And what does that mean? We also have a lot of nuclear waste. And this is valuable waste. When you take a nuclear reactor, and I know you're very familiar with this, right? This is more for your audience's edification than yours. But that nuclear fuel runs for 5 years. And within that 5 years, only 4 to 5% of that is actually utilized. The 95%, 96% becomes waste. So allow Curio, and Curio has proven, and groundbreakingly so, lab scale testing of this recycling capability. From that from that waste, we're able to capture 95, 96% of that waste into new secure source of nuclear fuel, not to mention the isotopes, some of the world's most expensive isotopes, needed for cancer treatment, needed by our laser industries, again, supporting the medical industry and space industry. I know that might be an area of interest too to your listeners.
Oh, yeah. And me as well, for sure. So we got like a dangerously low baseload of energy supply. You've got a really cool solution that is part of your portfolio. One of the other areas that I find interesting, I'd love to get your take on, is rare earths. So we've had some rare earth discussions with some economists, with some actual suppliers. We had someone that moves about 250 tons of rare earth. Phenomenal stuff. And I know when we first met, you were telling me a little bit about this. What are you seeing as far as what's going on with rare earths and some of the tectonic shifts that are happening around the world?
Sure. And again, I would love to have Rabbi and Yehuda continue this conversation with you. One of the companies they invested at their Synergos Holdings, which is the brother's family office, was USA Rare Earth, right? I think if I recall, one of the most important steps was really around regulation. Like, let's mine these rare earths, right? Let's find safe ways to do this, but let's get to the work of mine to magnets. So I think as long as regulation and kind of this raising awareness of what we can do and some of the technologies that will help us do that, I think that's going to be very, very helpful for us. Because again, this is a national security issue, right? Reliance on outsiders. And honestly, it's an economic imperative. I mean, would you rather find something here than have to import it at such a high cost? No, right? Obviously, there's an initial capital outlay that both public and private. And I think specific to rare earths, it needs private and public partnership. But let's get to that work, right? And by the way, it's not just reshoring. What I really want to focus on is building our own and strengthening our own supply chains. Because at the end of the day, we are part of a global ecosystem, right? So let's also share it the other way, right? Why should we be net importers versus net exporters of these critical minerals?
Yeah, brilliant. For the longest time, the U.S. has had a critical stockpile of oil and gas. I think, and maybe it exists, and I'm just naive, and the internet will be internet and keeping me honest, and please do that. But I think just as critical is a strategic reserve of rare earth metals. We've got magnets for different power plants. Microprocessors are a big part of that. Solar panels are a big part of that. A lot of what we run on is not just oil and gas, but also rare earths. And it comes down to not just making the economy work, but like you talked about, the sovereignty could be at risk if you don't have a critical supply chain in place for whatever country. But we'll talk about the US as well, and maybe Canada, where I'm at as well. Now, with that, before you mentioned that one of the big misalignments in the VC space is this issue, this obsession with these exits, and some of the things kind of go funny with that. So without exits as the main driver, how do you guys balance durability with liquidity?
I can keep talking about this, as you know, Ryan. So the companies that we invest in the commercializing stage, these are companies where we see we have a good sight to the exit, right? Because they're already revenue generating. They just need a little bit of an injection of capital so that they can commercialize much faster, lower their cost of goods, get to profitability level. And that clear focus on including this segment into the fund, again, really just allows us to then continue to invest in earlier stage companies. That balances the liquidity. And again, it's really about the conversation, that first conversation with the LPs, right? Being able to tell them that this is the part of these are the different parts of the portfolio. This is what we aim to achieve within the portfolio. Again, this transparency, communication, regular communication with LPs. I mean, how many funds are there that never even communicate, right? Because they go with the understanding or they continue, I think, what is a failure to investors that a venture fund is a black box. It shouldn't be that, right? We should always why am I finding out information about a private company in the public ahead of my fund manager, right? I'm responsible for my LP's funds. So that transparency of communication, where when we expect exits as they come into the fund with particular companies in their portfolio, I think that just takes away a lot of this. Rather, it just adds to the clarity between the relationship and the trust between ourselves as GPs with the LPs.
Brilliant. You mentioned a big one, something that's cool that you do. And I knew it existed, but I never saw it quite the right way until you brought it on, is coming in at late stage, coming in a little bit later in the VC model. And I know we're saying, that stage strata, if you're too rigid on that can cause a lot of problems. But just for sake of conversation, we'll say not necessarily the stage, but maybe the phase of the business coming in a little bit later. There's a bit of a strategy to that as it relates to durability and liquidity. I'm wondering if you can speak a little bit to that.
Yeah. So the impact really, right? One, we want all of our companies to become durable companies. We don't ever want this trade-off between your values as an investor and returns, right? I think for us, our mission is to deliver values and returns, deliver aligned with your values. The late-stage companies, again, we don't necessarily want a quick exit. Somehow, and as we continue to plan for this, we have a thought around creating a private equity for some of these later stage companies and continuing that relationship with the LP so that we're delivering dividends to them, right? So it's becoming, and you know this already, it's becoming a wealth management tool. And I think that just continues to, not only do we invest in legacy durable companies, we're actually creating a wealth management path for families to be supported in their journey by the Synergos Fund. The durability of other companies that need supporting happens because we allow for access to late stage. So really that is the impetus, is to get more people investing in these companies that need several funding rounds by giving them liquidity with a late stage, right? So these are different companies, yes, but then over time, they're going to see themselves, oh, my money from day one, I can now see it being invested, not just as a seed investor. Now Curio is in a Series A, it's in a Series B, it's in a Series C. So this conversation, I'm so excited to have this conversation with all of our LPs, showing them these milestone achievements. These milestones are these phenomenal companies. And guess what? It's a conversation, right? We're going to get input. We're going to get insights from our LPs too. And that's what we want. We want a strong relationship. We want a strong partnership. We want transparency. And again, I cannot stress this enough. We want mission alignment where values and returns are achieved together.
Yeah, purpose and profit. Who knew those can come together? Well, I know you do. So, a lot of the time, so we're talking a lot about constructing it with fees and being transparent and evergreen versus close-ended and fund model being what it is and where it's going and balancing liquidity. What would you say as far as constructing a portfolio, especially in this industry, but everybody constructs a portfolio in their own way, but let's focus on yours. What would you say is the logic behind taking, say, a 40 to 60% stakes of an early stage fund or position versus a smaller but later stage? What's the logic between those two as far as you guys see it?
Yeah, it truly is balancing that liquidity and risk management, right? We know that late stage tends to be the better risk managed because it's addressed, it's gone through the hurdles, right? It's gone through the hoops. These are commercializing companies. Hopefully they're revenue generating. I mean, we know that companies can IPO without even being profitable and never becoming profitable in their lifetime, right? But for us, revenue and profitability are key. But we take on this little bit, but it's also like a little bit in the late stage. But this is where we get that shorter time frame in terms of getting a return to our LPs. But we want them to take that liquidity risk, right, or lack of liquidity risk, or longer term investment in energy, sustainable energy companies like Gate 5. Gate 5 is one of the companies that we continue to vet. One thing is certain is that we're humans and the population is growing. Human waste can be processed and has the same density as coal to create energy, right? So it's it's imperative for the Synergos Fund, and honestly, this is the education, this is the advocacy that we go through with our LPs, is to let's all work towards clean energy together, whether it's clean base load and for us, nuclear with the recycled fuel, creating a secure fuel source with a small modular reactor. That's your clear cut closed loop solution in, call it 8 years, right? That's going to help the US, right? That's going to help our allies as well. And then sludge, sludge to energy. You take the solids, you burn it as energy, but what do you also capture? You capture that rare resource water, that important resource called water. And again, that leads all the way up to our agri-tech plays, right? Because what are we trying to do is grow, with OptiHarvest and agrology, we want to have precision farming that allows us to grow crops faster so that we use less water and also deliver higher quality produce for consumers like us. And the beauty is farmers get better margins, right? So you mentioned profits earlier, but this really is about making an impact on people. It's making an impact on what our economy is nothing without our people. So this is what we want to do. We don't necessarily need new technology. I mean, the world of sensors for agri-tech exists, but elevate that with AI, right? Then you have a faster way of, again, building and developing farmers to even do more and be better at their jobs, right? Because it's real time. It used to be that they would have to get a soil sample, send it to the lab, and 2-3 days later you get the results. Now you have it real time, right? And the technology and the information, right? Other farming countries, other farmers in the world can now access this information, right? So you're not just talking about U.S. sustainability, right? You're now talking about global sustainability. So we're very excited about our agri-tech focus. Again, it doesn't have to be new technology. Sensors have existed for the longest time, but add AI to that, and you've got a winning combination.
Brilliant. So, we've talked a lot about your the investment thesis, the fund structure, the fees. I'd love to switch a little bit to the operational side. So we're innovating on a lot of areas. So one of the things that I loved, and I learned this from you, so I'm excited to talk about this tool. Now, I don't think you're an investor in it. I know I'm not. I just want to make sure that I'm very clear that I don't hold anything in this company. It just sounds like a cool technology, and I learned it from Michelle. But how do tools like FAST, FAAST, how do those tools like FAST or governance frameworks help to keep your operational costs low and transparent?
FAST is a capability delivered by a company called Hatcher Plus. They're based out of Singapore. And it took a venture capitalist, it took an entrepreneur to build a strong AI-driven administration platform. We use it in 3 ways. It's our portfolio management tool, it's our client take-on tool, and it's also our KYC tool. So some of the operational expenses are really around KYC, right? And we focus on KYC. We want the best and the right investors to come into the fund, but we know that KYC is an expense. Typically, you would have used lawyers for this that cost a pretty penny per hour. And our point is to make venture accessible to a larger population, right? So this is one of the costs that we're able to lower through using the FAST platform of Hatcher Plus. And happy to connect to you, Ryan, with that group. Again, it's just the ability of the fund and the smartness of funds to use these tools that are strongly powered by AI. Let's take advantage of it, right? I think there still are pockets of investors that don't look at this because these are services that are standard to venture. But, there are providers, outsourced providers that are creating new standards. Let's embrace these new standards. I won't say names, but the other one that everybody uses, we all know did not, unfortunately, they didn't incorporate AI quickly enough into their process, which is why we discovered FAST with the Hatcher Plus group.
Yeah, I'm pumped after you told me about it and your experience with it. I definitely want to get in touch with the founder of that. I'd love an intro because that's really an important part. And back to those fees, right? So a lot of times you have these extra fees. But if you achieve efficiency, which is just good business, I don't have to tell you that, but for the sake of our audience, just another reminder is to say, as we're operationally excellent, the fee burden on both sides goes down. And so we don't have to charge a lot of fees, which then you would assume increases the amount that goes away from OPEX and into the actual deal, enhancing returns, effective returns for your LPs. and everybody's happy. And one of those great ways is to say, I actually don't need to tuck in those extra fees, which kind of, it puts a little bit of tarnish on our reputation. And people are like, well, it's shocking that LPs don't want to be surprised with hidden costs. Imagine that. So, you can avoid that by just adopting better tools. I absolutely love that.
And again, that's what allows the Synergos Fund to charge a management fee that encompasses all other fees. We want to raise also very fast so that we can keep investing in other companies. So very, very excited about the technology out there. And I think what I like about your community at Making Billions is really this cross-fertilization that's made possible, this cross-pollination that is nurtured. And I think if we keep doing that, it just has this multiplicative impact on the investing world.
Yeah. And with the investing world, there's a lot of different LPs and they like different things and they're aligned to different things. Alignment is a big part, especially as you go from what I call quadruple F, friends, family, fools, and followers, or as I like to say, people come to my house for Thanksgiving. So outside of that, you start to move up to family offices and institutions and sovereign wealth funds. And you're really dealing with massive asset managers, massive LPs. And that's where alignment really starts to kick in, right? We go from saying, look at all this money that we can make you and you're going to retire faster. And right, that works at high net worth. But when you're going into institutions, alignment really starts to take a front seat to us as fund managers and the things we want to pitch. So what kind of LPs would you say are most aligned with your model? And, how do you address some of those concerns?
Having been in the wealth management industry for, almost 30 years, I can tell you this, that the blurring between institutional and individual investors, there's been a blurring of lines between institutional and individual investors. At the Synergos Fund, we treat every investor, we get to know them quite well in terms of what their capacity is. We also know, Ryan, that larger institutional investors, some of them, yes, they write bigger checks, but we also find that some of them are writing smaller checks. And then you have the individual investors where we expect smaller checks, but actually believe in the mission so strongly that they're willing to allocate their capital, every year, accept another, $1 million from you, right? And that, imagine that goes on for the life of the fund. All of a sudden you have one investor that made that first minimum investment, but actually becomes a 20 million investor over time, and then has a successful exit, right? Successful experience with the fund. So yes, where we need the biggest chunks of money are really around, nuclear, for example, and these large projects, because we know that we'll need funding, not just from private investors, but also from the banks, right? So that's when, and again, that also falls not necessarily in the fund, but the underlying companies. But again, as we are taking very meaningful stakes in these companies, we are going to be participative in those conversations. And please comment on this, Ryan, because I know you're expert at fundraising. I think be open to any possibility. My only wish for institutional investors is, perhaps faster due diligence could be helpful. 6 to 9 months, we lose the opportunity to support these companies. And we don't like having to walk away from great founders and their great technology, again, that are solving real issues that persist. So I think it's all investors. So we encourage all investors to come talk to us. We're very flexible. We still do cater to accredited investors. But, my wish is that a broader group of investors can access venture. I
love what you said. And I do have a position on that. And it is this. I posted a YouTube poll that says, should you get the deal first and then the capital, or should you get the capital first and then the deal? And the overwhelmingly, they said, you got to get the deal first before the capital. And I actually have more of a contrarian position on that. To echo what you asked is for me to comment on this. So I will. All right. You asked me to comment. I'm going to comment. So what I think that it's better to get the capital first, raise the capital, and then go get the deals, which can be a bit of a challenge. And the bridge between that, because most people are like, you find a deal and then you go pitch the deal to investors and say, here's the deal. You want to throw some money at it. That makes sense. And I did that too. There's nothing wrong with that model at all. Nothing wrong with that. But what I've found over the years is actually, instead of trying to pitch a deal, pitch your thesis. And you can raise to say, here's my buy box. This is the way I see the world's going to work. We're going to raise $500 million to go accomplish those that fit into our buy box and that agree with how the world works, right? Like we need more impact investment. We have a dangerous base load of energy. We need nuclear, whatever that is. So you build your thesis and you go out and raise. And that's typically the fund model. And I find that when you can go out, then they're just doing fund due diligence instead of fund due diligence, partner due diligence, and deal due diligence. That's going to take a long time. And you've experienced it, and so have I. And you're like, I'm glad you checked all your boxes, but unfortunately, we don't have the deal anymore because it took 9 months to get this done. So how I was able to accelerate that, and for our listeners around the world, I'm sure you'd agree, for our listeners around the world, is to say, before you go pitch the deal, and I'm not saying don't pitch the deal, that's fine, there's nothing wrong with it, but you do run the risk that you were talking about, Michelle, is that they may also want to do that too. And they probably should. But instead, we analyze, we want to pitch it and pitch an investment thesis, get the capital, and then we go out more of, I realize I'm pitching a blind pool type of model right now. That's okay. There's many models out there, but if we're able to and build that trust and show, hey, you can count on us, we're going to come through, we're dead serious about this, we've got a great team, pitch our thesis, raise off our thesis, and then go out and complete the thesis. To me, that accelerates it. And what better place than you find a deal and you got the money to do it right away. And then you're the one who does deal due diligence. And it tends to be a smoother model. It's not without its turbulence. Don't get me wrong. It's got its issues too, but that's why we're here, right? LPs are trusting that we're able to look around corners, get things done, run our operations efficiently, use AI if we have to, but whatever that is part of the job. So I think pitching the thesis tends to help mitigate some of that counterparty risk or due diligence or whatever we want to call it, that risk of saying, if this takes too long, I might lose the deal. And that's not great for any of us because we put a lot of time in finding this deal and courting the founders and assessing the technology. And then it's all gone because an institutional investor wants to do their homework. Well, it's fine. Do your homework, but don't cause me problems in the process, please. So I think the best bridge to comment at your request tends to be maybe pitching a thesis and pre-raising with that thesis might help to put some salve on that burn a little bit. So if anyone out there is realizing it, I've been there, Michelle's been there, maybe try that approach or join a community that could teach you that, whatever that might be. So anything you'd like to add to that?
I appreciate that insight, but again, there could be situations where, yes, you try to foresee everything and then something comes up, right? So we have to be able to flex. And this is why, right? Once you identify the right companies, and again, the Synergos Fund, we're focusing on our first cohort of companies. I think that the conversation really did start with the mission, right? Not with the portfolio companies. So, you having me and inviting me to your show or having me on your show is really helpful to us to kind of emphasize, remind our LPs and in fact, invite others to look at that mission. But again, GPs, we're in the tough seat, right? We have to flex too sometimes. And sometimes there are good deals that we just want to get into. And then you're a little bit on the back foot. But I think if you have the right mission, then it's easier. And that mission is clear to the investing world. I think it's easier to go back to them and say, actually, this deal is here now. Would you like to join us? And if we can't get the quantum necessary, then we've done what we can, right? It's just an imperfect process to support transformative companies.
Well, you would definitely know your tip of the spear on that one for sure. And finding those transformative companies comes a lot down to how we source deals. And, some even argue that evergreen models, they risk complacency. How do you prove them wrong?
We can't be complacent at the Synergos Fund, right? Because our model is continuum. It's not just an evergreen fund, right? Because let's be clear, some evergreen funds, essentially all it means is they're continually fundraising. It doesn't mean that they're supporting the companies in different parts of their journey, right? The Synergos Fund, if we come in at the scaling, we'll be there for commercializing. If we come in at seed stage, we're going to be there to your exit, right? So we've built the strategy to be complacent free, right? It doesn't happen. It can't happen because, both from the founders, right? So founders too have to elevate themselves or do things better, right? We have in history, we've seen studies of founders that get just a chunk of money and fail because they ramp up expenses where it could have been done better by a kind of distribution or a deployment at different times, right? So again, complacency has existed, continues to exist in many of the investment strategies that we certainly have in our portfolios, but this structurally cannot exist in the Synergos Fund.
Brilliant. And how does legacy tie into all of that?
We want to build strong companies. One of the stories that my co-GP shares is that his grandfather has been receiving a particular dividend check from a large US company for many years, and then never even actually cashes them out, but like this collects the checks, right? So we want to be a durable company, right? That's the legacy. We want to invest in companies that have a runway and that solve real issues. For that very reason, we don't invest in SaaS types of companies. We want to solve large industrial complexities. Excellent.
So, I'm curious from what you're saying here is what practical steps can other fund managers or family offices what can they take to reduce that dependency on exits?
Identify the right companies from the get-go, right? Again, as we've structured as a continuum fund, we are looking at different companies in different stages. And what is interesting is, though not all of them have the potential of cross-pollinating, we find that different companies actually are supportive of each other. So allowing this diversified approach, we can have a 1-2 punch, not just with one company. We're able to address issues in the world with two companies, right, that are partnering up or that will position to large conglomerates or to other countries for implementation. So the building portfolios with underlying portfolio companies that actually have relevance to each other is magic, right? And we talked about it earlier. When you recycle spent nuclear fuel, you capture isotopes in the recycling process that is used by laser companies that treats cancer, right? So it's this, I don't know, my kid makes potions, right? So I think we're able, again, because we are supportive of founders, we want them to be successful. All of these insights from our founders, we bring all of that to bear to the entire portfolio.
Brilliant. This has been absolutely phenomenal. I've really enjoyed talking with you here. And so before we wrap things up, my final question for you is, what breakthroughs or global shifts do you think will shape capital flows in the next decade?
From a U.S. perspective, I'm really hopeful that more investors can access private deals. So in fact, those are the two things really. Is one, regulation, allow for non-accredited investors who have access to advice to access private companies. And I think private investments should and hopefully become mainstream, right? We talk a lot about our bankers, our financial advisors, underserving investors. We also need to help skill them up, right? So that they're not just looking at your vanguards, they're not just looking at your ETFs, but they're actually balancing that portfolio with elements of risk that entail investments in private or venture funds, private equity funds. Because the relationship of a banker or a financial advisor and investor, really, we're taking advantage of that kind of not too smooth a relationship, right? But it should be that way, right? Where there is that relationship, where there is risk-taking, there's proper risk-taking, and investing to the values, aligned to the values of the high net worth of the LP.
Thank you for that. So before we wrap it up, final thoughts, anything else you'd want our listeners around the world to know, any ways to contact you if they want to learn more, anything at all?
Firstly, Ryan, thank you so much. I appreciate the work you do at Making Billions. I'm looking forward to engaging with you more in your broader community. And again, I invite you to Washington, D.C. We'd love to have you here. We are creating an innovation ecosystem, building on an innovation system here. And I think your insights would be very, very valuable for the founders that are setting up here in the district. My list for your listeners and for investors out there and founders who are investors themselves, right, is that you don't have to choose between returns and values. And this is what the Synergos Fund believes in. We talk about conscious capitalism all the time. We talk about legacy. Really simply put is we want to invest your money the way you want it invested, because the meaning of the returns is not that it delivered 2x. Yes, we want you to get the 2x, 10x, 20x, but we want you to achieve your desires or your expectations, that someone's life has been elevated, right? Farmers have better ways of farming. Again, it ultimately benefits us as consumers. Education is facilitated, right? That you now have education. A lot of it is now AI supported, right? What's needed with AI is processing power, right? So let's bring other ways of increasing our baseload energy. And if you're interested in learning about us, please follow us on Synergos Fund. Reach out to us on LinkedIn. And we'll get, we're happy to have a conversation on what we do. Our website is also a great place to see what our thesis and our portfolio is looking like. But with that said, Ryan, I am so thankful to you. Let's help create more wealthy people, right? Not just wealthy people wealthier. Let's create a better playing field as it comes to venture investing and, frankly speaking, making an impact.
Brilliant. Well said. So just to summarize everything we talked about, focus on operational excellence to improve your returns for your investors while also building that positive legacy. The other thing is focusing on late stage investments can help to increase liquidity without getting rid of durability. And finally, leverage tech and AI to improve that transparency and LP experience. You do these things and you too will be well on your way in your pursuit of making billions.